Hopefully you can all see my presentation slide now, so we'll be able to move through. I've got a fun topic. I'm a fellow expat like all of you, and I'm actually an expat refugee at the moment, stuck down in Australia during COVID. And watching the property market with great interest from the front row seat, which is quite novel for me. Normally I'm just a flip in, flip out sort of guy, but it's been very interesting to see the dynamics of the market, full term. So today I'm going to talk about whether it'll crash or not. And thank you for your precious time, and we'll hopefully just race through this because there's a lot of information to share, and hopefully we'll give you a good idea and some good confidence. As with Craig, we need to start with a disclaimer. So just a reminder that this is public information, it's opinion only. Please don't act on it without assessing your own circumstances. Just a quick reflection. Back last year, when COVID hit, of course, the headlines were all very harsh. And you can see here, there was a prediction of a 20 to 30% fall in house prices. That was pretty much across the board. I think I couldn't remember hearing anybody say anything. And a good old friend there from Harvard, he reckons we had the worst property market in the world, massively overvalued. But I looked around for any positive headlines, and the only one I could find was this guy, that someone said, expect a mini boom. Oh, hold on, that was me. Oh, sorry, I didn't realize. So I was pretty much a lone voice back then. And if you want to tune as to why I believe that, it's not dissimilar to what today's will be, but the seminar session is online. Australian property issues during COVID-19, you can check it out. But there were some fundamentally good reasons why Australia wouldn't do that, and some of them we'll touch upon today. But you can see fear and opinion is always going to be readily available in every marketplace, and you've got to be able to filter through the thought process and see which ones have basis to fundamentals and the rest. And that's what we always try and do, and keep a level head and assess it. So let's have a look as to why we thought that. Interestingly, between now and last year, there's a few things that have happened. The government obviously went about it very, very positively to protect the property market in the main. But a lot of the activities that they took at the time are now starting to end. Now, one of the big ones was JobKeeper and JobSeeker. The government was helping, giving extra unemployment benefits, extra money to employers that had a 30% reduction in their revenues due to COVID. And they made sure that they kept those jobs alive by subsidising the ones that were still in work and increasing the spending and the revenue to the ones that weren't. They were great packages. They're now basically coming to an end. There's a little bit of lifeline in some industries likely to keep going. But, we've seen that the job market, expand. We've seen unemployment now return to pre-COVID levels. The economy is very, very good because Australia's managed COVID very, very well. The government also implemented specifically for the property market a loan deferral scheme. They were aware that people would have financial issues if they lost their job, etc. And they gave the banks $90 billion in order to allow clients that were affected by COVID to defer their loan for up to 6 months. Again, that is pretty much coming to an end now. But importantly, almost 90% of all those loans that opted into that scheme are already back in repayment and normal. So, it was there as a if necessary. It certainly was taken up by few, but it's proved to be not as necessary as first thought. But it was, again, a building of confidence to say, let's get ahead of the curve, not be reactive. And that was very strong in the way the government did it. They also brought in building grants to protect the industry. They've given people encouragement to build, renovate, and that's at state and federal levels. They're starting to come to an end. We're seeing pretty much those will peter out in the next month or two across Australia, both at state and federal levels. But they've created a building boom, which again is job creating, is activity creating, and is also investment creating. So we're seeing a lot of people take the opportunity to move into their first homes, upgrade their previous home, do the renovation. So that's been a terrific stimulus there. Has side effects. It's now created labour shortages and all sorts of things, but it was a good thing that they did it. We also saw stamp duty concessions. Victoria is giving you stamp duty concessions if you buy outside of the city. WA still has some pre-COVID concessions, 75% discount if you buy off the plan in WA, just to get that building industry, which wasn't in great shape, the development industry prior to COVID. So that's lasting through to October. So there's a few on the table, not very many. WA is probably the last of them now. Victoria for out of city. So get hold of those if you can. Anytime someone gives me a stamp duty concession, I'm all over it like a rash. And of course, interest rates are phenomenally low now. The lowest they've ever been, 0.1% is the official rate. Never ever before has it been that low. And interestingly, the RBA is saying that it's likely to stay at those levels, for around about 3 years, of which we're about 6 months into that cycle. So you can expect them to stay low for around about another 1 to 2 years at least. Now, part of that's going to be affected by the fact that housing is doing so well. So whether or not they choose to lift them to temper housing will be the big test. So we'll have to watch that at space. In terms of why the market won't crash, well, there's some very key reasons for it. And if we look at them, there's not one or two, there's many. First of all, what's different in Australia to anywhere else is we have genuine demand. There is a massive owner-occupier market, 70%. People want to own their homes. It's very popular. So that genuine demand is what stimulates. Investor activity is minor in the Australian market, not major. So that genuine demand is what's always been the strength of the Australian market. We've also now got an acceleration of expats returning now and also getting ready to return soon. So you've got not only a combination of the current, but the future. You've got a lot of expats that are back here now looking for their next home, willing to spend money. They've saved up cash. They're coming back. They want to have the lifestyle. They're not as worried about price points or borrowing anyways. But then you've also got a truckload of expats that have managed to weather the storm overseas, still have good jobs, and are now saying, well, hold on, this is a reality check. Let's start planning for 2, 3, 4, 5 years back. The market's strong. We should start acquiring. So that's a stimulating factor that's always been there, but has accelerated, not massively, but enough to start making a difference. You've also got significant local buyer activity, and many of them are upgrading, and whether they upgrade within state or out of state, they're taking the opportunity whilst there's a buoyant market, whilst there's a lot of activity, to say, look, I can get a good price and then maybe get a better home or move to a state and buy a better home for less money and retire. All that's going on. And interestingly enough, one of the reasons that I don't think a crash is on the books is crashes are usually caused by investor activity, not owner-occupier activity. And interestingly, investors are still a small part of this current push cycle. So we're not seeing everybody jumping on to make money. We're getting people to jump on to buy the area that they want, the house that they want, near the school that they want to send their kids to. That's their motivation, is lifestyle rather than profit. Investors are yet to come and step into that marketplace. And that's one of the reasons why the RBA is willing to leave interest rates low in the near future, because it's not investors that are pushing it up artificially, it's owner-occupiers that are driving it genuinely. Now, we've also got something to bear in mind in the not distant future, and that's the fact that we've still got the borders closed. So normally we would get 150, 200,000 migrants coming back into Australia each year, but they can't come at the present time. It's very difficult to get a new visa to Australia or even to start coming in. If you didn't have PR before, very hard to get processing. So you can imagine there is pent-up demand from these people that would normally have come over the last 12 months and likely are going to have stalled traffic for at least the next 6 to 18 months. So that's going to create long-term genuine demand, because those people are going to come, and they'll probably come in bigger clumps than they were originally intending. As such, we've got a very tight supply. One thing that people don't realize is even in a normal market, the average rotation in an Australian suburb is 5%. What that means is 5% of the stock is rotating every year in a suburb. What that means is 1 in 20 years, a property comes up for sale on average. Now, you've got to wait a long time, because the thing in Australia is none of the properties are the same. So all the houses are different. If you want that house, it's 1 in 20 years, but is it 1 in 20 years of the one you wanted? So there's always tight supply in every area, particularly the higher lifestyle options. So if you see what you want in an area you want to be, you better grab it, because it's a long wait before it comes back up. We're also seeing significant building pressure. Now, Australia's always been a big building economy because we're a new country. We're just starting to hit our straps in population, etc. So there's always building going on. But right now we can't keep up with it. The stimulus has come in. Bricklayers are charging a fortune. Materials are going to get more expensive. Availability of labour is a real problem. And of course, normally we would go to migration to fill that labour shortage. But right now we can't. So we can't bring in building teams from overseas because the borders are closed. We can't bring in electricians because the borders are closed. We can't bring in a lot of people because the borders are closed. And that's not likely to change for a while. The government even today has come out and said they're not likely to open the border well into 2022. You know, so that's going to be an issue in terms of labour. I think we're going to have to see, you know, some special concessions in special industries, and expect construction to be one of those. And of course, low interest rates are fantastic for everybody, which is terrific. And of course, it does excite people to act. But in Australia, we don't get carried away with low interest rates because it's not what we're used to. It's an advantage. But luckily, the banks are not drunk with a lower interest rate policy. And by that, I mean the fact that they don't lend you money based on the super cheap rate that they're giving to you today. They add 2 to 3% to the current rate in working out what you can afford. And they do that because we have a law in Australia that says unconscionable lending is illegal. If the bank lends you more money than you can afford, you don't have to repay the loan. So the banks are very cautious in how they assess how much loan you can get. So they're doing it at 3-4% more than you're lending at the moment. So that means you can cope with rate rises in the future when they come, and it's not going to become a massive problem in the market. So all those things combined create a very stable platform of which growth can happen. And that's important because that's unique in the world. There's very few markets that have the same level of owner occupation, the same safety and lending practices, and the same quality migration that Australia has. They're the key elements that haven't just made it safe this last year, but have made it safe the last 30 years that I've been doing this caper. If we look at population, you know, being the key issue, and again, if you've ever heard me speak on any matters relating to property, this is my most important element. Population is key. If you don't have new population and you keep building, you end up with oversupply. So if you're going to keep building houses, you need new people to live in them. Now you can see for the September quarter, the Australian population growth has gone to the lowest it ever has been at 0.9% growth year on year, September to September. You can see in the previous years, which were, I always do it in December normally, you can see it's been at 1.4, 1.6, 1.6, 1.5. So this is the lowest we've ever had. But bear in mind, the reason for that, the borders are closed. It's not that people stopped wanting to come to Australia. They just were told, sorry, not yet. There's a pandemic going on. We don't want to bring that in an uncontrollable manner. We're going to have controlled borders, controlled arrivals, fixed quotas, and those quotas are likely to stay for quite a while. But you can see, even with 0.9% growth, that's still a significant growth. You know, there's 300,000 more people in Australia this year than usual. That's a lot of activity in the marketplace. So you can see there that that's, one second, that's creating a lot of consumer demand. These 300,000 people need somewhere to live. Now, most of this is natural birth, so people are needing to upgrade from 1-2 bedroom apartments into 2-3 bedroom houses, villas, etc. So that natural evolution at a time of encouragement with interest rates being low is what's stirring that genuine demand underlying. Now, if we have a look and see, one second. You know, if we look at who is the arrivals, you can see it was originally during COVID, majority of citizens returning, but we're now getting back those PRs that were worried and couldn't get back in with the quotas. We're seeing an increase in the number of arrivals coming back to Australia. Now, this is important because not only is it quantum, but it's qualitative and it's financial. The general profile of people arriving in Australia now is expats that have saved some money, migrants that have got substantial wealth that can go and afford a house, a bigger house, 2 houses, a retirement, a lifestyle. Even with a lot of our clients, and we look after a significant amount in aviation and hospitality, which are the 2 most affected industries as a result of COVID, we're doing an incredible amount of interviews and appointments with our clients that have lost their jobs, but are therefore accessing their retirement schemes. A lot of them were moving into their 50s and 60s and thinking about retirement anyways. So they're basically just having an early retirement, and they're coming back to an environment where they can still get a lovely home with their savings and have enough left over to live a wonderful life. So once they get over the initial shock of losing their job and probably never working again, they all of a sudden realize that, wow, maybe I better get a better fishing rod, and away they go. So, they move from worry to happiness very, very quickly, because it doesn't take a lot of money to have a wonderful life in Australia, unlike a lot of other places. Now you see the forecast for population growth by Treasury was 0.2% for 2021. It's already at 0.9 at September being the latest numbers. I think that 0.2 is going to prove to be too low a forecast, and therefore there's going to be economic uplift from it not being as low as they thought. You can see that net overseas migration, they figured it would be in 1920, 154. It's come in at 184. So it's more people coming back than they thought. I don't think they fully appreciate how many Australians have taken the opportunity to come on home, be with their elderly parents, enjoy a wonderful life, cash in their chips, and go to an extremely good existence in Australia. The September quarter for actual net migration was 34. The whole year estimate is 72. But again, it's going to be hard to see what that number will end up being, because their borders are now likely to be closed longer. So we're going to have to see what happens in these numbers. And a lot of it is going to center around when the government starts to relax those border controls. And expect that when that happens, we're going to have a second wave of this property boom. If we look at some of the components of it, and this again is one of the key elements in terms of picking where next, you can see the interstate migration has a massive impact on property. New South Wales is losing 20,000 people a year to other states. Luckily, that's complemented and offset by the fact that 28,000 overseas people come back. But that net interstate migration is normal for New South Wales. And what's happening is it's just accelerating in current time, because they're now getting record prices for selling their New South Wales properties, and are able to go to places like Queensland, which is the biggest winner, up to the Gold Coast, Sunshine Coast, all these places, and start living incredible retirements where they get much, much more house for much, much less money. And when you sell a property in Sydney now, it's realistic to expect that you could sell that, clear your mortgage, buy a house somewhere like Queensland debt-free, and still have enough money to have a wonderful life or a casual, relaxed job. So they're taking advantage of that liquidity in the market, fueled largely by those expats coming back, the foreign investment, the future migrants that are buying. All of that is letting the money rotate and roll and go. WA is getting a lot of new migrants back, because lots of West Australians like myself were expats, but again, we're taking advantage of the really, really cheap, high quality living in Perth. And I can tell you for a fact, Australia has the cheapest luxury property market in the world. There's nowhere you can get as nice a property in as nice an area, like for like, anywhere in the world than you can in Australia. Believe me, I've hunted and looked. If we look at what's the key driver of this current activity, it's actually ownership, rather than investment and speculation. Now you see the ownership rate had actually been dropping a little bit over the last, decade or so. The top two lines on that chart, demonstrate who owns their house with or without a mortgage. And you'll be surprised to know that there's a large portion of Australians that own their house outright, over 30%. Now, it used to be 40%, but now it's down to 30. Now, that's not because people are paying less off. It's sometimes they're recycling the debt to invest in a second home, investment, etc. So you can't afford now, with house prices being as high as they are, to be debt-free on your house. We always encourage people to pay it off and then grab it back to invest and earn secondary income that not only covers the interest cost, but can put extra cash in your back pocket to fuel a retirement, pay for school fees, supplement your lifestyle, enjoy yourself. But when you combine the two, it used to be just under 70%, ownership rate in Australia, and it's dropped in recent time to about 63, 64. But if you look at the housing loan commitments graph, you'll see there's a massive spike in the amount of new home loans being done, And you see literally the great majority of that is in owner-occupier activity. Investor activity has picked up, but nowhere near the pace owner-occupier has. So what's happening is, with all the stimulus, with all the stability, with all the low interest rates, everybody's saying, I might as well be an owner than a renter. It's now, believe it or not, cheaper to own a house with a mortgage than it is to rent in Australia. Now, how long that stays like that, 2, 3, 4 years, who knows? But you would be mad not to take the opportunity to become an owner-occupier while you can. Now, the biggest hassle most Australians usually have is deposit. Now, many are taking advantage of their parents, many are finding it from somewhere, taking advantage of some government schemes that were introduced to help you get over the line with a smaller deposit. Whatever it takes, it's worth doing, because it's cheaper to pay off a mortgage and reduce your debt than it is to pay the landlord. And you see investor loans are still quite strong, so there's still been a building up of investment activity, but not to the same extent now as owner occupation. So I'm expecting that owner occupation to lift from about 62, 63 back up to 65, 66, 67, because it's such a good time to step over the line, and a lot of people are ceasing their procrastination. The Australian property market has always had 3 phases: slow, medium and fast. That's not changed. If we look at where everywhere is, Perth is still very opportunistic. Brisbane is about to go boom. It's been doing very well for the last year, but that net interstate migration benefits Queensland greatly. So they're going to get a lot. Sydney has been in its down cycle, which you'll see in a sec, but is now very, very strong buying and still hasn't got near its peak, I hate to say, but it's so expensive you need to bring your A game. You've got Darwin that's just sitting there. It's had a resurgence. It's out of its decline. Adelaide is in really good shape at the moment, and Melbourne is still good value and going into its next growth phase because, again, population. Now, it's lagged behind everybody else because it had the worst result out of COVID. It was the only state that had to go back into, lockdowns and restrictions. It's had a lot of impact from that. It's also most affected by the fact that students, which live in the city, and tourism in Melbourne with a lot of Airbnb apartments, has been massively impacted. So that's going to take longer to recover in that sector, but that genuine buying market is still extremely strong. To give you an idea, you can see here, one second, if you all do that survey, that would be great. Let's have a look. So you can see here in the last 3 months, the market has been very strong. The September and December numbers, 3.6 growth for the quarter, 6% for the December 20 quarter, is extremely strong bounce back. Now you can see here in June, we did have a minus quarter, but interestingly enough, we had a bigger minus quarter in the March 19, June 19, because of the federal election, than we did as everyone being worried about COVID. People were more concerned that Bill Shorten was going to get in as Prime Minister and take away things like negative gearing for property investors than they were about a global pandemic. Who could believe that? That doesn't make sense. But that's the reality. Now, the reason for that is because the election was just something we were worried about. The pandemic made us do things that were real, such as looking around our house going, wow, if I'm going to be stuck in here for 3, 6, 12 months in the future, is this where I want to be? I don't know if I like the small courtyard. I don't know if I like this suburb that much. If I've got to be stuck again, I better upgrade. So next time I'm locked up, I'm in a nicer place. Now you can see, there was the effect of the fall. So the Australian property market is so stable that the net effect, the worst effect, was in June 20 with only a 1.8% decline because of what was the world's biggest problem in 100 years. 1.8% was the margin of decline, and instantly picked back up, in the next quarter, and then boosted into profit. Now, is this a boom? I'm not so sure. It's pretty much normal. If you look at the year-on-year results to December, the December 12 months was a 6.6. December 19, 4.6. December 18 was a correction in Sydney because it got too overpriced. It was at the peak of its market, growing far too strong. So it had to cool down. But you can see, apart from that, we're not in massive growth numbers. The problem we've got is everybody's still thinking, can I get it at the cheap price of a year, 2 years, 3 years ago? And when they go and find out no, they're grumpy. And they go, well, that's not fair. I didn't want to pay a bit more. I wanted to pay a bit less. So of course we're feeling bad and we're calling it a boom because we've missed out. But the thing is, it's not going to come back. If you're waiting for that magic recorrection, it's not going to happen. And if it does, the house you wanted isn't going to be for sale for 20 years anyways. So guess what? You're going to have to wait 2 or 3 cycles. So you can see here, the numbers aren't madly huge. They're just a recorrection of what was a softening effect. And now an acceleration as genuine demand is strong and procrastination is almost being wiped out. You can see on the overall averages in the last year, 6.7% for Sydney, 8.8 for Brisbane. Perth is the worst performing because it's been in a lull market. It was just starting to get in motion and then everyone got worried about COVID. But you can see this is the reality. Look at the average prices. Sydney, 1.2 million. Good luck finding a nice house in Sydney for 1.2 million. If you can, congratulations. But it's very hard because that's the average. But the thing is, there's a lot more money in the market domestically and with the new coming expats and with the new coming migrants, and they're willing to pay premiums for scarce, rare and quality suburbs and houses. So good luck if you can find it for 1.2. Interestingly, as I show everybody, you see Sydney is a 47% premium to the average across Australia. It was a 54% premium last year. That's too high. Just like in 2017, we said that has to contract. It did. It got away from itself in 19. It's come back to 47. It still needs to be sub 40 in my mind. But the great value is Brisbane and Perth and Adelaide. You can see they're massively under the average. And what a lot of people forget is that the average wage in these outside suburbs, in states, is now a lot higher than Sydney. So you can actually go to Perth, go to Queensland and get the same job on the same money, but get a much better house and therefore a much better lifestyle with less pressure. Again, 10, 20 years ago, you had to go to Sydney to get the big money because those big money jobs weren't in the Melbournes and the Brisbanes and the Perths. They are now. So, this is a distortion that many people haven't picked up. It's a phenomena that I think will just be left uncharted. But you see, the long-term average is still good. Now, we're not seeing massive double-digit growth rates at the moment. So when everyone's talking about a boom, I'm going, what boom? Yes, prices are decent now. They're a little bit above what you want, but they're not massively distorted for what you're getting. And that is the key. If we have a look at rents, this is the other reason why the market is so stable, because the rental is tight across the nation. The Australian average is 3%. That's one of the lowest in the world. You can see Sydney got up a bit high because it had been going through a building boom prior to COVID, and a lot of those properties got completed and released onto the market in the middle of COVID, and therefore there was extra supply. But you can see that's even turning around now with a contraction of 0.6% in the recent quarter. So the vacancy is tightening up. Melbourne is at 5%. That's the highest and is expanding, but that's because most of what they built there, what we call stops, small, tall and overpriced, not really livable stock, but ideal for students. Ideal if you want to go and have a lovely weekend in Melbourne. What a great city. But they're not long-term livable apartments. So it's very normal to see that now being a higher vacancy factor because they don't have the students yet. They're working on it, might happen in the near future. They don't have the tourism yet, and they're working on that. So that might be taken up pretty fast. But Brisbane and Perth, look at that. Perth is now under 1%. Only a couple of years ago, Perth was sitting at 5% vacancy, 5%. It's now at 0.8. Now you can see the corresponding uptick on the rents. The rents are now starting to go up. Now bear in mind there was a COVID freeze on rents. That's now coming out. So people are now getting shock therapy when their rents are coming up for renewal. But that's because the vacancy at 0.8 is super tight. 0.8 is not normal. And we've got the same in Adelaide. So you can expect those markets to be strong. Now, unfortunately for people in Perth, there is a building lag. Even if we wanted to say fix the problem today, good luck having something delivered and available within 2 to 3 years. So we're going to be in this tight market for quite a while. Now, luckily, the government did do the stamp duty concession a couple of years ago, and so we hopefully should have supply coming in, but it is really, really tight. They're looking to accelerate things now. But this, again, makes it very safe across Australia because we have genuine occupation. Owner-occupiers are strong, and the property market, which are investors, have a good pool of really good tenants paying their rent on time, no hassles, no worries. And this is after having moratoriums during COVID where you couldn't get rid of your tenant, so that you had to support them. They didn't get rent free, but they got rent, support. They didn't have rent pressure, but they're paying that back and everything's turning back to normal. So this is very, very strong for the Australian property market, that the rental market is in such good health and tight. It's really bad news if you are a tenant, and hence why we're also seeing a lot of tenant pool going, we can't find anywhere to rent, we might as well buy, we might as well build. And a lot of places in the last 6 months across Australia, you've been competing with building grants and subsidies, but they're all about to expire. Now, what that meant was, renters were saying, okay, we'll stay here renting and we'll build a house, it'll be ready in 12 months and we'll get 30, 40, 50 grand in subsidies. They don't get those subsidies anymore, and they can't wait the 12 months to build now. So they're now going to have to go back into the established property market and meet those challenges there. And guess what? That's going to create a further stimulus over and above what has been going on. A lot of the genuine demand has been redirected into new build homes because of the incentives and the grants. That's going to turn around and aim directly back at the established property market, creating even more demand, even more pressure for the right properties. And that's the key. You need to have the right properties. Let's have a look at some of the issues of buying and selling. Well, obviously at the moment, access and viewing is not easy. It's always been somewhat difficult as an expatriate, but it's even hard in some places in Australia, particularly while COVID worries continue. We're seeing, the fact that Australia has, pretty much conquered and mastered COVID overall. We'd have, currently no community, transmission cases whatsoever. But we live in this eternal nervousness that we might have one. And again, for all you people overseas, you may not realize that we consider officially an outbreak of COVID in Australia is if one person gets it outside of the hotel quarantine system. So that's one, O-N-E. Right? One person gets it outside of hotel quarantine. That is called an outbreak, and borders closed. It's immediate here. That we don't muck around. So what that means is, even with the property market, having home opens and that, they're not sure that if there's one person gets it, that you'll still be able to have a home open or an auction or whatever. So there is issues. But what happens is alternative technologies have come up. You can get video now. So if you're overseas, it's not that hard. You just have to get over your own mental barrier of saying, okay, I can't see it, I don't want to buy it. Well, you better. The video is good. You can have someone do a walkthrough, find someone you trust, family or whatever, get in there, have a look, check the video out. If it's within Kui, grab that sucker. Obviously, auctions, if you're on the East Coast in particular, in Melbourne and Sydney, they're the dominant way properties get sold. So you need to be aware that you have to go there. Now, bear in mind, if you go to an auction in Australia, you have to be able to prove that you can pay the price you bid. So you can't go there without pre-approval or proof of funding. So make sure you're ready to go. You can have people that will go to auctions. We do it ourselves on your behalf, put you on the phone, and you can go, yes, 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 too much, no. But just bear in mind that you can do that. It's difficult, but it's doable. Most of the property outside of New South Wales and Victoria is done by negotiation, which means it's online, it's available. You can go in and say, look, I'm willing to pay this. They either accept or not. But just bear in mind, the sellers are back in control for the first time in a long time. You're going to have to meet as a buyer the seller's price rather than them meeting yours. So don't outsmart yourself and miss out on a lovely property for a couple of $1,000s that you thought you should get it cheaper. Always remember, the market price is what someone is willing to pay. So if someone is willing to pay more than you, then that's a higher market price. Are you willing to keep going? You know, you are in control of your destiny, but obviously don't go crazy if the property doesn't meet your needs. If it's not the one you want, why pay over the odds? Keep hunting for the one you want. You've also got to remember that entry costs are on the rise. Now, interestingly, New South Wales has got a proposal on the table to get rid of stamp duty, but it's a bogus thing. They're not getting rid of stamp duty. They're allowing you to pay it as an annual fee over a long period of time rather than an upfront. You know, but every time the prices rise, because your entry costs, such as stamp duty, are a percentage, so too they. You know, if it's 6% and the price goes up, so does the 6%. So you've got to bear in mind that the cost of delay is not just the increase in the value, but it's the increase in the entry cost. Don't push it that far down the line. When you do buy from overseas, you also need to be mindful of land tax, because when you rent the property out, if you're not living in Australia, you will have to pay land tax. And that's got pretty nasty across the board in Australia for expensive houses in particular. So just make sure that you're aware of whatever the land tax might be when you buy before you commit. Now, it's definitely not a reason not to buy, but you need to know what it will be. Particularly, for instance, in Sydney, if you buy an ugly old house in a really good suburb, you might end up paying $10,000, $20,000, $30,000, $40,000 a year in land tax. You know, and if it's an old house, some of those, the rent isn't enough to cover it. Now, if you're happy to pay for that because you want that gorgeous view of the Sydney Harbour Bridge and the Opera House and the best suburb in Sydney, so be it. But make sure you're aware of it. So when you're looking to buy, don't just look at the house, but ask what is the land tax position. If you rent it, the agent will be obliged to tell you. If he doesn't, talk to us, we'll let you know. You know, and you've got to be prepared. You know, it is harder if you're overseas to get a loan. Even in Australia, it's not easy to get a loan. So you better make sure you get your loan pre-approved, that you're ready to act, that you're psychologically in tune, particularly if you go to an auction. You've got to discuss with your partner, what is our real maximum price and how far above that are we willing to go for the right property? Now, I don't want you to be crazy. I don't want you to be, you know, spending more than you need to, but you have to assess how much is the property worth to you in the current market. It's hard to get bargains right now. You know, and you've got to remember the good news is if you do buy from overseas, there's lots of renters. You can see the vacancy factor at 3% means you're going to get it rented. It's just a matter of being sensible on the rent, you know, finding the right people and having it ticked out until you eventually want it, or rent it forever if it's for investment. There's also the fact that remember that you need to look after your tax. Now, we do that for you. You have to lodge an annual income tax return if you're living overseas, if you've got rental in Australia. Regardless of whether the rent is more or less than your expenses, you have to lodge. When you sell it, there's capital gains tax issues. Now, in Australia, you don't pay capital gains tax on your family home if it's your family home. If it's been rented for a period, then you just have to make sure that you've got the tax implications assessed. Again, we'll help you with that. That's a whole nother seminar. They're on our website. Go and check them out. We've given you lots of information on those. And if you're selling a property from overseas, you just will find that if it's over $750,000, you're going to have a withholding tax of 12.5% of the sale price retained if you're living overseas. Now, that's not the tax payable. That's just a provision until you lodge your tax return to calculate the actual tax. So you cannot get a clearance certificate if you're living overseas. In Australia, if you sell a property, you must get a clearance certificate before settlement, or they will deduct the 12.5. But it's easy. It's automatic. If you're living in Australia, you just get the form, bang, no withholding tax. If you're overseas, you're either going to pay the 12.5, or if that is more than the actual expected tax, you can vary it down to the lower level of what you think it will be. We can help you do that form. But you do have tax issues. A reminder that if you are an expatriate living abroad, you know, you used to get your family home, you know, for the period you lived in it, tax-free capital gains. You do not get that if you sell that home while you are living overseas. So please do not sell your family home, your former family home, when you are living out of Australia before you have checked what the tax implications would be. You may think that it will be tax-free, but it will not if you are not living in Australia at the time. Talk to us about that. We'll help you out. Okay. In terms of your property options, well, obviously you can buy property direct. It's very simple. You can just buy it in your name. But you need to be mindful that there are FIRB restrictions, and by that it just means if you are not an Australian citizen or a holder of an Australian permanent residency visa, you cannot buy a established property in Australia. You can buy a property, but it must be brand new. So the only restriction for buying Australia is if you are a foreigner, and a foreigner can buy, but can only buy brand new. So apart from that, no hassles. You can build a house as a foreigner, you can buy an apartment that's being built, you can buy a brand new apartment that's just completed, but you cannot buy a second-hand property as a foreigner. But that does not apply if you've got citizenship or Australian permanent residency. You can buy joint ownership with your wife. They have either tenants in common or joint tenants. Joint tenants means that if one of you die, the ownership transfers automatically to the other. Tenants in common means that it goes to your will to be dispersed in accordance with your instructions. You can use companies and trusts to buy it. Now, generally speaking, we don't recommend people buy property in companies. Again, there's tax implications of that. In a company, you will not get your family home tax-free status. So as a general rule of thumb, you wouldn't buy in a company. You might buy in a trust because it's a more flexible vehicle, only if you think you will never live in that property, okay? But again, you should get tax advice before you buy in a structure. We can talk to you about that. Always bear in mind, only genuine long-term investments should go into trusts or companies. It's not always advantageous. It's not always easy to get finance, so there's other issues to consider. You can also buy in terms of your options. You can buy in a collective ownership structure. So you could buy in a private trust where you come together with others and use that to buy the properties, or you could buy in a public trust where it's, people you don't even know. Again, at SMATS, we have options for you in that. We have our consortium, which allows you to take some property opportunities, and we're about to release the Australian Residential Property Fund. Look out for that in the not distant future, so that you can get participation without foreign buyers fees and all sorts of things. And of course, there's value adding through development. So you can go and buy a property that could maybe knock down and put a duplex, triplex. You could do that singularly or in syndicates. So again, we offer that to our clients. You can come along and participate where we do it as a group. The advantage of value adding through development is normally the rotation. You can buy properties, rotate inside 2 to 4 years, do the next one. The profitability can obviously be more attractive because you're taking something, giving it a polish and making it something better. And that can tend to add more than the market would generally offer. So you've got lots of options in getting into property in a whole or in part, depending on what your circumstances are. In terms of, let's getting on with it. How do we get into the market? Well, generally speaking, for anyone, you need a deposit of between 5 and 20%. Now, expats, it's very, very hard to get a deposit less than 20%. So, if you're living overseas, 20% is really your guideline. If you're in Australia, you can go from a 5, 10, 15, 20% deposit. But importantly, it doesn't have to be all cash. It can also be alternate security. So if you already own a property that is worth substantially more than the current mortgage, you can use that as the 20% deposit. For people living in Australia, you might be able to even use your parents' property as a part alternative security. So there's options there for you. Bear in mind that when you buy a property in Australia, usually you're going to be up for costs of about 5 to 6% of the purchase price. Primarily, that is state government stamp duty. So now it depends on the price of the house. The cheaper it is, the lower it is, the higher it is, the higher it is. Plus, you've got legal fees, usually in the order of $1,000 to $3,000. So you'll need to factor that in, but 5 to 6% generally will cover that for most people. If you are a foreigner, then there's extra duties. There's a federal buyer's fee of $5,000 to $25,000, and there's also a foreign buyer's state fee of 7 to 8% of the purchase price. Now, importantly, this does not apply to anyone living overseas if they are an Australian citizen, and also if they are an Australian permanent resident visa holder anywhere except New South Wales. So New South Wales, if you're a citizen, you don't pay it. But if you are a permanent resident visa holder or a Kiwi, then you are going to be charged that 7 to 8%. So you need to be mindful, because we do have a lot of clients that live overseas and their spouse is not a PR, or maybe if they're buying in New South Wales is, and they don't realise that they're going to be tapped up 7 to 8% foreign buyers duty, on that half that they allocate to their spouse. What that may mean is that you buy it 100% in the Australian citizen's name, and then later on, when you're living back in Australia or you've got your citizenship, you can transfer it without duty and cost later on. But you need to be mindful of that, because that's a significant cost. And if you didn't realize it was there, you're going to be smashed. There's some government incentives. Like I said, there's some building grants starting to come to an end. They were available for Australians and overseas investors, now starting to cross off. The stamp duty discounts, basically only WA has got that now, with a 75% discount on both the stamp duty and also the foreign buyer's fee. So if you are a foreign buyer, WA is opportunistic, WA is safe and savings wise, and it'll get you in the door at a better property. And if you're a first home buyer, there are incentives varying from state to state. Importantly, what a lot of people don't realize, that if you are living overseas, you can go and buy a property as an investment, and that doesn't stop you from getting first home buyers grants when you eventually come back to Australia and buy your first home that you intend to live in. So don't be afraid to buy waiting for that. It's still available. In terms of interest rates, wow, they're super cheap. You can see there on the graph, they're at the lowest level, 0.1%. The last rate rise was November 2010. The RBA says they're going to stay like this for a couple of years. And the fixed rates in particular are super attractive. For owner occupiers, they're less than 2% for up to 4 to 5 years. For investors, 2.5% to 3% fixed for 4 to 5 years. Never before has it been this good, not just in Australia, but around the world. But Australia, this is unique. We've never got this low, even during the GFC and Asian crisis and everything else. I'm just glad I'm hooked up to the eyeballs, so I can just get a whole lot of cheap interest rates, because it's hard to get a loan, but you need to lock those rates in. Now, for the first time in a long time, we now actually are penalised if we go interest only rather than principal and interest. So we've always said go interest only, and that was because the interest rate was the same for principal and interest or interest only. Now it's less if you pay off some money. You might as well do that unless it impacts your cash flow adversely. And the servicing rules are getting better. It's still difficult if you're overseas. It's still difficult, but they have relaxed it and become more sensible in Australia for people overseas and in Australia, from various banks. But it's very hard to get a loan. You need an expert. Get onto our specialist mortgage team. We'll sort you out. Getting towards the end, in terms of what we've got here, so we've got low servicing costs at the moment, mean that we've got a perfect storm in the housing industry. It's fantastic to be an owner. Better to be an owner than a renter. Best time ever to be an investor. Basically, no negative gearing. If Shorten had not even talked about negative gearing, he'd probably be the Prime Minister. And he didn't need to, because low interest rates mean that nobody's negative geared anyways. We've got genuine demand that is not likely to subside anytime soon. We've got a very tight rental market. The supply lag will take a long time to catch up with. And by the time it catches up, the demand will have increased anyways, because they'll have opened the border and let people in. We've got a massive scarcity in good quality property, and that's where you want to be. The market is split in two, between junk and good. Don't buy junk. Junk is dangerous at any time. Good market, bad market, whatever. Buy good property, and good is not hard to figure out. It's large size and livable. It's a good location, a good view, near a good school, whatever it is that makes it good for that particular property. So get something that you would enjoy living in, even if it's just for investment. If it's not livable, it's not investable. And for the first time in a long time, we got confidence and fear equally balanced. In fact, the only fear that people have right now is fear of missing out. So, that's why they're willing to pay a bit extra on the price. Confidence is strong, fear is limited. That means that you're going to have to meet sellers' prices. Again, don't be ridiculous if it's massively over asking, but what you want to do is ask the selling agent, how did they establish that price? What comparables? Ask your advisor, what do they think? You don't want to be ridiculously over, but you don't want to miss out if you love the property. And what we've got in Australia, again, unique to us, I think, is we've got an increased capacity from the local market, where they're now more affluent, they're more confident because we've conquered COVID. We're still, leading the pack there. but we've also got expanded capacity in the market from expatriates returning with bigger budgets, migrants coming with bigger budgets. So every sector is more affluent than it used to be, and it's not getting any cheaper to do subdivisions. It's not getting any cheaper to do developments. So you're going to have to get your capacity enhanced or buy early before someone outbids you. Get cracking. And I've just put here, I think, and I've held this view for over 25 years, that Australia is the world's preferred destination. COVID has made this even more so. Wait till the rest of the world finds out how well Australia not only managed COVID, but conquered it. And we kept the community safe economically and physically, and that hasn't been achieved anywhere else to the extent that Australia has done. And that's going to be an eye-opener for anyone who has a reasonable amount of sensible wealth in terms of choosing where they want to live for the rest of their life with their lovely family. And that is going to fuel genuine demand growth in Australia for decades to come. Australia is a wonderful place. Everyone wants to live down there. That's why the property market won't crash. That's why if you're lucky enough to own your properties already, you should be feeling very, very happy. And that's why if you don't own it yet, please get off the sidelines, find something good, and get as good a price as possible that you can negotiate. Thank you.